You're listening to Earnings Unscripted, where we unpack what really happened in today's earnings. It is Wednesday, January 7th, 2026, and today we are looking at Albertsons. For a long time, the only story here was will they or won't they merge with Kroger, but that ship has sailed. The lawsuit drama is, well, it's mostly in the rearview mirror, and management is calling this a new day. So, Miro, looking at the print this afternoon, does it actually feel like a new day?
It feels like a messy day. Look, if you just look at the profit and loss statement, it's a blowout. Operating income jumped 66% to nearly $490 million. Adjusted EBITDA crossed the billion-dollar mark, up 22% from last quarter. So they are squeezing a lot more profit out of every cart of groceries.
Which usually makes Wall Street throw a party, but I'm looking at this screen and I don't see any confetti.
No confetti. The stock sold off immediately at the open. It finished the session down about 6%, trading around $16. It's a classic case of the headline revenue scaring people off.
Because of the pharmacy stuff.
Exactly. And before we get too deep into the pharmacy math, quick reminder for everyone listening, this is just us talking. We are not financial advisors. This isn't financial advice. Do your own homework. But yes, Susie, the pharmacy stuff. Since January 1st, literally a week ago, the Inflation Reduction Act changes kicked in. Basically, it changes how drug prices get recorded. It lowers the reported revenue line for pharmacy, but the profit dollars stay the same. Management called it optical.
Optical. That is such a CFO word. It's like saying we look shorter, but we're actually just standing in a hole.
That's surprisingly accurate. Yeah. It's a 65 to 70 basis point drag on the charts. So the algos see revenue miss, they sell the stock, and the price drops 6%. But if you look at the actual business, identical sales were up 2.4%. Loyalty members hit almost 50 million. They are proving they can run this thing solo.
50 million members is wild. That's a lot of data. So you got the market panicking over optical revenue drops, but underneath, the engine seems efficient? Or is efficient just code for we cut costs because we're scared?
Well, they did cut costs. Selling and administrative expenses dropped to roughly 25% of sales. But here's the thing. They also launched a $750 million share buyback. You don't do that if you're scared. You do that if you think your stock is cheap and you have cash to burn.
Okay, so they're betting on themselves. But the market is looking at that pharmacy headwind and maybe, ignoring the efficiency?
They're ignoring the leverage. Net income was $293 million, up from $168 last quarter. That is a massive jump in pure profitability. But right now, the noise around the IRA and the lingering legal stuff with Kroger is just, it's clouding the lens.
All right, so we have a profit boom, a revenue illusion, and a market that's clearly in a bad mood. Let's dig into what those numbers actually mean for the business. So strip away the sentiment for a second. Let's look at the actual mechanics. The stock is down, but you call the profit and loss statement a blowout. Where is that disconnect coming from?
It's a game of inches. Top line came in at $19.12 billion, up just over 1% sequentially. Identical sales, which is the real pulse check here, came in at 2.4%. So that's a slight acceleration from the 2.2% we saw in Q2.
Which is decent in this economy?
It's solid. But the magic trick was further down the sheet. Gross margin hit 27.4%. That's up 40 basis points from last quarter.
40 basis points. To a normal person, that's a rounding error. But in grocery retail, finding 40 bibs is like finding a gold bar in the lettuce aisle.
Pretty much. And they did it while battling food inflation. They claim it's all productivity initiatives, automation, labor optimization. Basically, they saved enough money in the back office to offset the price cuts they had to make in the aisles.
And digital is still doing the heavy lifting.
Oh, yeah. Digital sales up 21%, pharmacy up 18%. Although, remember what we said, that pharmacy strength is exactly what gets optically weird next quarter with the IRA changes.
Right. Enjoy the 18% while it lasts on the print.
Precisely. But look at the bottom line. Net income hit $293 million. That is up 74% from Q2. Even the adjusted EBITDA popped over 22% to $1.04 billion.
Okay, so they are running a tighter ship, but I saw something in the balance sheet that made me pause. The debt load spiked, didn't it?
It did. Total debt, net of cash, is sitting at $8.82 billion now. That's up roughly $1 billion from where they were implied in Q2.
Why leverage up now?
Two reasons. One, some refinancing, but two, and this is the aggressive part, that $750 million share buyback we mentioned earlier. They're essentially borrowing to buy their own stock.
Which screams confidence, or maybe a lack of better ideas?
Or just capital return mode. They're not a merger target anymore, so they have to act like a standalone compounder.
Speaking of acting like a tech company, I saw a little nugget about AI in there. Usually when grocers say AI, I roll my eyes, but they actually put a number on it.
They did. They launched this AskAI search tool in the app. Apparently, for the people using it, basket sizes are up 10%. 10%?
Just from a smarter search bar?
That's what they claim. It's early days, but if you can get someone to add one more fancy cheese or a bottle of wine because the algorithm suggested a recipe, that is high margin revenue.
As optimism with a spreadsheet, as you'd say.
We'll see if it holds up, but for now, the P&L is efficient.
All right, so margins are up, digital's flying, and they're buying back stock. On paper, it looks like a clean break away from the merger mess. But, you know me, I can't help but look at that debt pile and wonder if the strategy actually holds water long term.
Yeah, and that's where the narrative gets complicated. Because running a standalone grocery empire is very different from dressing one up for a sale.
Exactly. Let's get into that.
Right, and this is where I think the market is missing the real story. Everyone is looking at the grocery aisles, but the actual strategy is happening in the servers. Because if you want to survive as a standalone grocer in 2026, you cannot do it by selling bananas. The margins are garbage.
Bananas are a lost leader, I know. But you're saying they're pivoting to, what, tech?
In a way. Look at that loyalty number again, 49.8 million members. That is nearly 50 million people giving Albertsons real-time data on exactly what they eat, when they buy it, and how price-sensitive they are. The deep dive here isn't the food, it's the media collective.
The ad network.
Exactly. The research file mentions double-digit growth in their media business. Think about it. We just talked about that AskAI tool, lifting basket sizes by 10%. Susie, that isn't just a helpful kitchen assistant. That is a high-precision targeting system.
Oh, I see where you're going. So I ask the app, what should I make for dinner with chicken? And it suggests a recipe that just happens to use a specific brand of salsa that paid for the placement.
Bingo. And that brand pays Albertsons for the privilege, that ad revenue. It has 90% margins. Selling the actual jar of salsa, maybe 25% if they're lucky. So the standalone strategy is basically turning the grocery store into a physical interface for an ad tech business.
That is both brilliant and slightly dystopian. It's like they're monetizing the indecision of dinner time.
It's arbitrage. They are using low-margin groceries to acquire high-margin data. And honestly, that's the only way they justify the valuation now that the Kroger premium is gone. They have to prove they aren't just a box selling commodities.
Okay, but here's the rub, Miro. You can build the fanciest ad tech mousetrap in the world, but you still need people to actually buy the salsa. And on the call, Susan Morris was pretty explicit about the consumer. She said middle-income households are showing signs of softening, and low-end shoppers are putting fewer items in the basket.
Yeah, that's the gravity pulling the rocket back down. You can see it in the trade-down commentary. People are switching to private label, which, by the way, ACI wants to grow to 30% penetration. But if your shoppers are broke, your ad inventory becomes less valuable because the brands know the conversion rate is dropping.
So it's a race. Can they scale the high-margin media business fast enough to offset the fact that their actual customers are running out of cash?
That is the multi-billion-dollar question. And frankly, with debt up and cash down, they don't have a massive runway to get it wrong. The buyback buys them some goodwill with shareholders, but it doesn't fix the macro.
It feels like they're trying to fly the plane while upgrading the engine to a warp drive.
Right, and hoping the passengers don't notice the turbulence in economy class.
Right. So that's the part that really changes how I see their whole strategy. It's not about groceries anymore. It's about the ecosystem. But let's step back for a second and think about what all of this means going forward into next year.
Yeah, because the guidance for 25 just got narrowed and 26 is staring them in the face.
So where does this leave them heading into next quarter?
It leaves them in a bit of a show-me phase. They narrowed the full-year guidance for identical sales to between 2.2 and 2.5%. That's solid, but it's not leaving much room for error. And honestly, the next quarter is going to be noisy.
You mean the optical stuff again?
Yeah, we talked about it earlier, but Q4 is when that IRA headwind hits full force. We're talking about a 65 to 70 basis point drag on reported sales starting right now. Management keeps saying it's profit neutral, which is true mathematically, but try explaining that to a trading algorithm that just sees revenue shrinking.
It's like they have to win the argument twice. First, they have to sell the groceries, and then they have to sell the math of selling the groceries.
Exactly. And they have to do it while the consumer is trading down. If that softening in the middle class gets worse and the optical revenue drop kicks in at the same time, the narrative could get ugly fast.
And there is still one ghost in the closet, right? The Kroger lawsuit isn't technically gone.
Not entirely. The trial over that $600 million termination fee is set for October 2026. It's a long way off, and the market has mostly moved on, but it's still a massive legal overhang just sitting there on the docket.
So putting it all together, short pause, they've declared a new day. They're buying back stock. They're pivoting to high-margin media, and the stores are running leaner than ever. But the macro clouds are gathering, and the government just messed with their revenue ruler.
That is a pretty fair summary. They are betting everything on execution now. There is no merger safety net anymore. It's just them, the consumer, and the debt.
So, yeah, another quarter that somehow answers nothing and everything at once. They're swimming hard, but the current's getting stronger.
It usually does at this stage of the cycle.
All right, let's close this out. You've been listening to Earnings Unscripted. And before we sign off today, I want to take a brief moment to explain exactly what this project is. Earnings Unscripted is an experiment by a small team of enthusiastic people who are exploring the frontier of AI and really how it can be used to enrich our understanding of the world. This entire episode was created by a team of AI agents, starting from the research analyst who parsed the earnings report, to the scriptwriter who drafted our dialogue, to a fact-checking QA specialist, and finally to Miro and myself as the hosts. We are all working together to deliver high-quality, up-to-date information at a speed and depth that would hardly be possible otherwise. The goal isn't just to read numbers, but to see if technology can help us tell the human story behind the data. So if you have questions, comments, or just want to share your thoughts on the format, please reach out at earningsunscripted@datamadness.ca or follow us on X. We would love to hear from you.
See you after the next call.